Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
Monday, October 12, 2009. I steadfastly believe that this recovery will fall somewhere between the normal growth rate after major recessions and the current consensus for sluggish growth. Today's guest is Robert Johnson, Associate Director of Economic Analysis for Morningstar. Robert Johnson has more than 20 years of investment experience, including both buy-side and sell-side assignments as a research analyst, which includes stints at Stein Roe and ABN AMRO. Johnson earned a bachelor's degree in chemistry and business administration from Carroll College and a master's degree in business administration from Harvard University. Robert also holds the CFA, or Chartered Financial Analyst designation, and is a member of the Investment Analyst Society of Chicago. Robert Johnson, welcome to the program.
Nice to be here. Thanks for having me.
You're welcome. Tell us, what's going on in Chicago today, Robert?
Well, it's cold and rainy as usual.
As usual? Winter has started. Did you pass right past autumn?
Absolutely. It absolutely did. We're like in the middle of November right now.
Oh, Lord. Well, hang in there. This too shall pass, as Dad used to say.
Actually, in a way, it's a positive for the economy, believe it or not. I mean, we've had, in the summer when we had relatively cool weather, it did horrible things to consumer sales of apparel. And now that we've gone into fall and it's been unusually cold, the stores are just packed with people trying to buy that last-minute winter and fall gear. And
is that so?
Yeah.
Well, you know, this recession is different from any other we've experienced since the Great Depression. It's more of an asset crunch and credit collapse scenario than the typical inventory corrections we're used to, right?
That's correct. I mean, it is driven. Certainly, what drove us over the wall, so to speak, was the credit portion of it. But you know, kind of prior to last September, October, it was proceeding somewhat like a normal inventory cycle. The consumers had cut back a little bit. The autos had cut back, and I believe, actually, probably different than some, that there is some credit cyclicality. I mean, there is some normal cyclicality. And the credit made it worse, and so those two together is what's happened. But partly what will get us out of this mess is some of that cyclical, normal stuff, so to speak. So
is this cyclicality you speak of, could that possibly be inside of a bigger secular cycle?
Absolutely could be, and I'm frankly still relatively bullish on the overall long-term economy, given some growth in developing markets that will present new opportunities for us. We've seen some pretty dramatic improvements in productivity statistics recently, so those are all positive things that could help the long-term growth, whatever kind of happens here cyclical. Clearly, the other side of the coin is that you know, the consumers have more debt. It's going to take us some time to leverage all of that, and so you're going to have some of that going on also, and you might have higher taxes here, and that certainly wouldn't be a good thing. So that's why I think things will be better going forward, but maybe not as robust as, say, they've been for, say, the last 20 years.
Well, I do want to get to the consumer in a moment, but being how you are in Chicago, I did want to ask for your comments on this. Your own Chicago Fed's National Activity Index, which is arguably the most reliable economic barometer around, given its breadth of subcomponents, posted a negative 0.90 print in August, and the key three-month average came in at a negative 1.09. Now, the Chicago Fed warns that anything under negative 0.7 or worse still signals an economy that is in a contraction mode. So can you give us your thoughts on that?
Sure. I mean, there are a lot of people put together a lot of different indexes that are leading and lagging, and you know, that is one that's had a decent track record. There's some others out there. I tend to focus on a few indicators myself that I like to look at rather than adding, you know, hundreds together and getting some type of average. I tend to look and say, well, which ones are kind of the most meaningful, and what do I feel is moving, and see if there's some kind of story within the indicators rather than just adding them up. And clearly one of the things that I've been positive on is the purchasing manager survey has been positive now here for so many months, and we're starting to see some of that get into the numbers. So I think that's certainly one of the positive things that's going on out there. And Initial unemployment claims is another area where I think there's really been significant progress. And those are two that usually move pretty far ahead of everything else, and they have again this time. So those are the ones I look at. You're right. The the Fed Chicago index does have a pretty good track record. But there's others too. The Conference Board's leading economic indicators are in one of their best positive states in some time.
Right. You mentioned the Purchasing Manager Survey. Is that the same thing as the PMI or the ISM?
That's correct. I'm referring to it by its old name, Bad Habits Die Hard. It's Institute Supply Management, ISM, and
wasn't I know that
other names too.
I know the non-manufacturing number was a bit of an upside surprise, but wasn't the manufacturing number last time well below expectations?
It might have been modestly below expectations, but it was still above the magical 50% number, which means more than half the people thought things were expanding rather than contracting. And it was actually off a tenth or two from the prior month. And keep in mind, we've come all the way from a number around 27 to up over 50. And now we came back a couple tenths. So 1 month doesn't worry me, and I checked back the track record, and almost every time, kind of 4 or 5 months in, that number does backtrack just a little bit. And as long as we stay above 50, I'm feeling pretty good yet.
You mentioned payrolls. I remember September non-farm payrolls showed 260,000 jobs lost.
Yep.
And I was well above consensus estimates, at least until Goldman upped their number late Thursday to 250,000. How did that happen? Maybe you've got some insight on that for the rest of us.
I think I'll leave that off.
Okay, that's a wise decision. We also saw the average hourly work week slip back to 33 from 33.1, and as I understand it, every 0.1 decrease is the equivalent of about 400,000 jobs. But the question I really wanted to ask you, Robert Johnson, is the BLS also quote-unquote discovered an additional 824,000 jobs lost between April of 2008 and March of 2009?
Sure.
Can you fill us in on what in the world these people are doing?
Sure.
Or not doing?
It's a very complex argument to talk about, but the key thing to mention is that certainly from March on back, it looks like they were too optimistic when they were taking some of their survey techniques and moving from kind of questioning a few organizations and then extrapolating that out to the whole population. They have to make assumptions, and some of those assumptions were clearly too bullish, and so we're starting from a bigger hole in terms of number of jobs lost. But frankly, that number's probably made made March and earlier, if it was done correctly, would look worse, but maybe the more recent months would look a little bit better in comparison.
Yeah, so I see. Well,
it's very complex. What it is, when they send out surveys to corporations and businesses, and when they don't respond, they can respond just because they're too busy, they didn't get to it, it got lost in the mail, or it could be they went out of business. And making assumptions about why they didn't return those forms is what really makes things very tricky. And then they also make an adjustment for new businesses start up. When a business is just starting, they're going to have no way to get, they're not going to be a telephone directory, they're not going to be the normal sources for them to figure out to send them a survey. And so those types of things are hard to catch, and their adjustments appear to be a little bit off this time, and they're going to go back and adjust. And like I said, the net import is that the recession is going to look worse than it did before in terms of jobs, if it didn't already look bad enough. But the good news is that maybe it'll make the improvements going forward look a little bit better.
Right. You got a lot of good points, and it makes me feel better personally to hear you talk about it. But it is hard for the layman to get his head around all this. Can you just kind of wrap up this portion of our discussion by trying to answer this question?
Sure.
My understanding is the consumer is about 70% of the economy. How can the American economy recover without the American consumer?
It's very, very difficult. I mean, there are ways. I mean, we've gotten out of some of our recessions by export sales, and certainly that's kind of been a help so far. But I don't know if I totally count on that. But certainly that's one way, and we've seen some of that. Things that ship into China and some of the basic commodities that might be produced. Some of those things are showing signs of improvement, and it has helped our economy. There's just no No doubt about that. At the same time, our consumer is weak, so we're not buying as much stuff from overseas. So that's a big help on the GDP number. So that's one way we can get out of it. The other thing is with consumer, you've got to be a little careful about that. It is 70% of the economy, but the consumer, and has been an important part, maybe a little less, but always been a very huge part, over 60% of the economy. And what tends to happen is the people that have jobs, and in many cases continue to get raises, maybe a few less this time, but the 90% of the people that have jobs feel more confident and decide to spend more. Gee, I'm not going to lay my job. I'm not going to get laid off. It seems like this is kind of stopping. I feel good enough to spend. I saw my neighbor on the right get laid off, and 6 months with my neighbor on the left, but you know what? It's been another 6 months. The guy across the street still has his job. I still have my job. And you know what? I've been saving a little bit, and now, gee, this car looks cheap, and the cash for clunkers thing, or gee, there's some real opportunities here. Maybe I'll buy this or that. And so it's that 90% of the people that still have a job that bring the economy back. And same thing on the debt side is that what will come back is not despite what you read, it isn't like 100% of the economies have stretched every dollar on their balance sheet and are up to their eyeballs in debt, and just there's no way out. No, there is some proportion. I don't want to make fun or belittle it. I mean, there's 20 to 30% of the population that's probably pretty well geared up in terms of leverage and in a pretty tough situation. And for those people, I feel very sorry. And I think as we come out of the recession, it's the people that don't have as much debt that say, you know what, prices have gotten so attractive, and I've been so cautious. Gee, I'm going to splurge a little, and I that's what gets an economy moving again. It's actually not more jobs. The jobs usually come later in the process. It's the people that have jobs feeling confident enough to spend more, and then you get more production, and then you get more jobs. That's how the cycle flows.
I see. We're going to continue with Robert Johnson in a moment, but first a reminder that on next week's program we'll have from the University of Washington, Yoram Bauman, Ph.D., the world's first and only stand-up economist. It should provide us a nice break from all the seriousness we've experienced the last year or two. Robert, let's talk home prices.
Sure.
Case-Shiller showed prices gained 1.3% in July, and that sounds like good news, but what I can't seem to get out of my head are these estimates that peg the shadow inventory of housing, which is homes that are in foreclosure or soon will be, at roughly 7 million units. You tack these onto the official unsold count of 3.6 million, and it seems to me we're looking at an overhang equivalent of close to 25 months' supply. Can housing have really hit bottom?
Well, I think in some markets it already has, and I think if you look out to some of the California markets in certain price ranges, there's only if you try to buy a home in the 200 to 400,000 range in some parts of California right now, you couldn't buy a house. There are parts of California now where there are more people calling up the bank saying, have you got any foreclosures for us this week? That there just isn't enough supply out there in the foreclosed, lower-priced homes right now. So believe it or not, there are some parts of the country where that's actually true right now. And what's interesting, by the way, everybody says, well, until employment gets better, you're not going to sell any more houses. Well, the unemployment rate in California is probably one of the highest in the union right now. I think it's up over 12%.
Right.
And it's gotten worse at the same time the housing market there has gotten better. So you don't necessarily have to have one to have the other. So that's one point I'd make. In terms of the inventories and the shadow inventories and whatever, I think you have to be a little careful about what comes on the market and when, and is some of the shadow inventory really, people are looking and saying, well, if you add up the number of junk mortgages and the number of Alt-A, whatever term all the different types of mortgages out there, look how bad it is. Well, some of those you can't count. They're not matched. We know how many mortgages were originated and when, but we don't know how many of those have already been foreclosed on, how many have already been put on the market. The guy says, you know what, I know the end is near. I'm going to sell this thing for what I can and get the heck out of Dodge. And you've got some of that so that it's already come off the market. One other thing I'd like to point out with the 7 million houses, too, is that what really is new supply is the number of new homes and the number of new units built. That's what really counts, and that number has been lower than any other time in history. And that's really what new supply is. If 7 million homes come on the market, those 7 million people are going to have to live somewhere. I mean, those people cannot all move in with mom and dad again, or vice versa for that matter, whatever the way the pattern goes. Those people have to live somewhere, and I think that some of those units that are out there today could easily become renter units or whatever. I mean, unless we all go live in a cave, those 7 million homes will find, and I don't know that I believe that number is the correct number, but if one does agree there's some number of excess homes out there, I'd ask the question, is it really excess?
Okay. All right. Well, let's expand this conversation to more than just real estate and talk about credit contraction. I've read recently that bank lending to the private sector has just plunged, and the decline over the past 3 months has exceeded a 16% annual rate, which is just unprecedented. Since June 10th, the yield on the U.S. 10-year Treasury note has plunged 70 basis points, and at the same time, the S&P 500 has rallied 14%. The bond market seems to be telling us we live in a deflationary world, yet the equity market thinks the all clear has been sounded. We couldn't let you go, Robert, without you giving us your outlook on the bond and the equity markets.
Sure. The bond market's got a lot of different forces working in it right now, and clearly, as you cite some of the credit contraction items that are going on out there, credit always decelerates or goes down the first year or so of a recession, and the reason is that people need less working capital, they need less inventories, they need to go to the banks to borrow less. So some of it's because the banks are tight and don't have enough money to lend, but probably a bigger portion of it is actually that businesses, you know what, if my sales are down 5%, I need 5% less inventories, I need 5% less for my accounts receivable, and so there's less demand for credit as well, and so that's one of the things that's happening out there right now. So on the credit side, and why I'm not terribly worried about that side. You noticed in the Cash for Clunkers, by the way, the Sherlock Holmes story, you're probably familiar with, the mystery is solved by the fact that the dogs didn't bark, which meant that the victim knew the person or whatever. Well, the dog that didn't bark with Cash for Clunkers is, we didn't hear one story about, we heard about all the paperwork snafus and all this and not enough inventory. Did you hear anybody complain in Cash for Clunkers they couldn't get a loan during that period, or that slowed things up, or that messed up the program? Not once. And that was on the news every night for 30 days, and we didn't hear one peep about, we had all these people signed up, and then they couldn't get a loan. Didn't happen. And so that's the so-called dog that didn't bark, that part of the cycle, where I think that credit may be more available than some people think. Certainly if you've got bad credit or live in certain parts of the country, it's next to impossible. But I think if you're a halfway decent credit, there may be more money available than you think. Now, bond rates. Bond rates are a little tricky in here. I personally think the economy is going to be a little stronger than people think. I've thought that interest rates might move up. I've been wrong for the last 4 to 6 weeks because and a couple of the Treasury auctions have clearly gone well. Certainly people have been willing to save, and a lot of the demand for the bonds has come from people in the United States saving more. This time around, it's not China and other countries coming in and buying our bonds. A lot of the demand this time has been U.S.-based. So that's brought some rates in a little.
And comment on this just very quickly. 6 months ago, the big concern that there would be a buyer's strike from overseas bond buyers, but that doesn't seem to have materialized as well, has it?
Well, it's hard to get the mixes and read all the numbers and get them right, but I certainly think that some of them have shifted to buying shorter-term bonds instead of longer-term in terms of foreigners. And I do think that this time around that there's probably been a greater portion of the demand has actually probably come from U.S. citizens. That doesn't mean that the overseas bond buying is falling off a cliff, but there's clearly some U.S. bond buying going on by U.S. citizens.
And do you think that's part of a longer-term secular change in the American investors' attitude towards risk?
I think so. I think they're saving, and
getting closer to
it's interesting. I think a little bit. What I seem to hear from people that they're going really conservative with a fair amount of their money. And again, I don't talk to necessarily a really broad range, but just a few individuals. That seems to be emerging where people are being relatively more conservative with most of their money, and then they're going out and buying a taking a flyer on a few things, if you will. A Citibank in the day, or a Ford Motor, or even an AIG. All the stocks that had gotten really hit, that had a decent brand name, but somebody said, if they go away, there's not going to be anything left of the economy anyway. Not that logic was perfect, but that I think a lot of people took a bunch of their money and got conservative with it, and then rolled the dice with some of the rest of it.
Right. Robert, this has been just wonderful, a real breath of fresh air for all of us. I can't tell you how much I've enjoyed having you on the program today. Is there anything you'd like to add before we shut her down?
No, those are the main things. I think we've got a positive inventory cycle in front of us. I think housing has probably laid down a little bit of a bottom in here, and if one had reason for concern, it would probably be on the commercial real estate side. That's the one part that kind of keeps me awake at night a little bit.
Mm-hmm. All right. Well, today's guest has been Robert Johnson, Associate Director of Economic Analysis for Morningstar, and that wraps up today's MTA podcast. I'm Ed Carlson, coming to you from Seattle. You can follow me at fatechnicaladvisor.blogspot.com or contact me at fatechnicaladvisor@comcast.net. Send us your comments and suggestions. Let's keep our stops tight, people. Good day.